everyone, good morning and welcome. Welcome. I can see some familiar faces here. That's people that have come to our previous webinar. It's so great to have everybody join. Thank you so much. So as usual, we're going to start immediately and we will just take on what we're here to do. Hi, so my name is Grace Effiom. I'm the head of enterprise here at Lens Square, and I remain your host. As usual, I've brought in someone incredible to join us on this specific topic. And due to his expertise in the industry and his contribution, well, if you wouldn't listen to the benefits of what this regulation has done for you as a lender, maybe hearing it from another person is going to give you more insight. So we're going to start with an introduction, then we'll go into a fireside chat with Mr. Akanmu, and then we're going to go into Q&A. Please, just to drop, you would not be able to speak, and that's because so that you don't interrupt the session. So if you want to drop any of your question and answer, you're going to drop them down in the chat box, which has been made available for you, or question and answer. Just use the question and answer session and you drop it, and we will be able to see this. Then we'll go into closing remark. We hope to start exactly like 10, which we have done, and we will end this exactly at 11 as usual. So for those that are new here, you're welcome to the webinar with Lens Square, where we get to talk with some of our lenders and then discuss certain topics of importance during the quarter. The topics always come from the lenders' contributions, so the top places where they might have raised our concerns for them in the industry during that quarter. Those are the places that we get to speak about. I will go into our introduction. Sir, good morning, sir. How are you doing today?
Good morning, Grace. Thanks for the invitation. Good morning, everyone.
Good morning. Thank you so much. So I'll just start with, if you could just give us more insight on what you've done in the past. We've already informed the team about your contribution in the education sector. We've discussed about also in the fintech sector. And then we've published this as well, just so that they can get to know you better.
Yeah, thank you for the invitation. This is a very important topic. It's good for it's a very key topic for the fintech community and society, and I look forward to having a good discussion. My background is in the consumer goods industry, telecoms, banking, and fintech. I've had the rare opportunity and the privilege to work at C-levels in these industries, and I hope to bring those insights and experience into the conversation on something very topical in terms of consumer credit, which impacts industry, but even bigger in terms of impact on society. Thank you.
Thank you so much, sir. So for those that are here that are not fully aware of what the topic is and what the evolution for FCCPC has been in the past, here it is. So previously, I'll use like around 2019. That was when a lot of people did notice the major contribution as well, especially in the industry, where we noticed the switch from it. Before now, we had a couple of mobile applications, or they called them the Indian apps. That's what they used to call them there, that were all over the store. And the first thing we noticed was FCCP was mandating that you must get FCCPC approval. And it was very chaotic because a lot of people had applications that were on Google and Play Store. But now Google Play Store is telling you, for you to push this application, you must have done FCCPC registration. Then you go ahead to say you want to do FCCP registration, and then you find out, there's a whole lot you're supposed to do. There are, you have to do NDPR audit, you need to provide X, Y, and Z, literally focusing on the consumers 100%. And it did create a lot of, I would say, reaction from the industry. We went from a huge size of people that were already using or had applications up on store being brought down. So this change came, it did come unexpected because some of the lenders were running through, and I would say those specific categories of lending applications weren't even licensed apparently. But with that change, everyone had to ensure they got their lending license, whether it's going to be a Lagos State license that is issued or you want to get a court license, that's based on if you're operating in a state level, but everyone had to bring a specific license that allows them to operate. So we've watched a lot of progress in this thing, but lenders are still very much reluctant in terms of how and why they see it as a constraint to them and not so much for the borrowers. They see it as it's favoring the borrowers. But we're coming from a place where customers were usually being harassed. You would see, some, I would say, toxic messages being sent to customers and their family members with regards to, if you don't pay my money, this person is going to be killed. And really, really bad words being thrown out there. And it forced the hand of FCCPC to just put a bit of tightening and scrutiny. If you're going to publish your application, you must have adhere to the different guidelines and all the rules that we have laid in. But not everyone was having it. So today's questions are going to be tailored towards just talking about this. And this is the evolution of consumer lending in Nigeria. It goes all the way back to before 1992. We had situations where people have already been giving out loans. Now, in your area, you've always had that place where you can go and you drop something and you take money, and then you come back again and drop your item, collect your item and repay the money. It has always existed. At least I know from where I grew up, we had one madam that you could always take money from around the side. She wouldn't give money to people that she doesn't see in the neighboring company, in the neighboring streets, but she's always available to give out loans. And then we had coins. So it was coins that were given to us. Mom was like, okay, and collect coins, come back, and the rest of it. And we've seen the act grow from 1992 into May 2019, where CPC was created, and also to be able to protect the consumers as well. Then we noticed the big shift in March 2022 when we had a joint task force, and that's of the Federal High Court just authorizing enforcement as well for the digital lenders, just to ensure that the consumers are protected. Then 2003, then we had one into 2026. I'm just picking bits of the major ones. Of course, we still have the one that came out in 2020 and the rest of it. And of course, the one we are discussing here, which is the DEON regularization, the one released in 2025. We still have the one coming up in 2026, which has been given to lenders as a compliance for them. But let's just run through of it. So my first question to you is going to be, what do you see for you from your own end? What do you see that this shift in communications and in the regulations to all of the lenders and all of this, what type of capital are you would you say we are more likely to enter into consumer credit following the rules and the regulation that DEON has given?
I think first, thank you, Grace. Before we even talk about capital, maybe let's discuss the benefits of, to make a response to the benefits of this regulation. I wear a little bit of academic hat, which is part of the things I do. And what's a good market? A good market is an organized place where buyers and lenders, buyers and suppliers and sellers know themselves. They know who they are. If I sell to you, there are maxims that compels you to pay me. And if I buy from you, I also know that this is the product I'm getting. There's integrity of what I'm buying. The nature of also a good market is that there's a free exit and entry of people. And when it functions, people come into that market from different places to fulfill their need. One other key character of a good market is that information is available widely between buyers, sellers, and their intermediaries, which means that I know what I'm buying, I know who I'm selling to, I know who's selling to me, and therefore the pricing mechanism can work better and optimally to maximize the potential of the market. When these things are distorted, or when you have other buyers being too powerful or having more information than sellers, for example, like a bad A bad borrower knows himself or herself. The lender doesn't know. Or when he's queued on the other side, markets don't work effectively. And on the long run, there are consequences. The market doesn't grow. There is no competition. Innovation is limited. And the way to see this regulation, even though there might be initial concerns, is the order and predictability that it gives to the lending industry. You mentioned the days when you said Indian apps, which means anything goes. I don't even know who I'm borrowing from. And the app lending to me doesn't even know me very well. Maybe my identity is not even right. It's not even in place. Maybe I'm even stealing an identity. So a lot of chaos out there. What this regulation is going to do, even though there might be initial concern, is to bring order, predictability, competition, innovation, in which the powers of buyers and sellers are much more balanced. Information is much widely available for us to innovate. And what that does is that it gives investors confidence to do more business. When I know a market is ordered and structured, I know that the risk in the market is much more controlled and limited. So one thing of this, which I will get into that very clearly, this regulation is likely going to significantly de-risk the lending market. It means the volatility that we see, I can make money from A, I may not be sure of B or C. Even if I don't know, I can price the risk of that bad guy appropriately. So these are the benefits, and investors love this kind of story. Are much better than when we put a deck together and we say the market is chaotic. Investors don't typically like chaotic market. They like to manage their risks down, even when they are doing venture capital. Venture capital doesn't mean throw money into chaos. So that is the benefit, and we're going to talk more about this. Thank you, Grace.
Thank you so much. I like the emphasis on the benefits and it. And just to speak to it, yes, if we have a chaotic setup, it actually creates more chaos in the sense. Everything felt like there was nothing that was putting together or holding them accountable. From the borrower's side, you would give all of your information to somebody that you have no idea where they are. And tomorrow you're hearing, oh, my information has been leaked, and you cannot pinpoint who or who didn't. Yes, I'm coming out to look for a loan. I'm applying for loans at different places. But in a situation where I need to hold someone accountable, I should know. We've had scenarios where, let's say, a customer has come back and said, oh, I have been told that I'm owing XYZ person and I'm trying to reach the person, and this because they probably want a place where they can get like a letter of indebtedness just to be able to clear their name in the future place. And you'll see scenarios where they're not able to find. I've had multiple users that have mistakenly found us, Lens Square, thinking we are the ones that gave them a loan. And then we're checking in our ecosystem and we're seeing that this person has never reached our side, or we have no information. But then they're sending emails and even as much as threatening us and telling us how, oh, I gave you my details. And I'm like, you didn't give me any details. Then when you ask them information, they might not give you there's the app name for some lenders, and then there is the business name. So I can't go Lending Technologies Limited, but my app name is Lend Square, and that's the app that everyone will be seeing. But these consumers don't know that it's Lending Technologies Limited. So they just see anything called Lend, and then they start sending emails and bombarding with calls. And then you have to now pinpoint that, okay, if this is the lender you're looking for, maybe search. Sometimes, if I'm in a good mood, I must confess, I go to the end of, okay, this is who you're looking for. I found their website, take this link, go there and make your complaints. It speaks to not being able to have that balance where both the person taking the loan and the person that is receiving know each other very well. It seemed like it was one-sided, where it was the borrower that were providing more information about themselves to some of these people. So the regulation also helped. And the interesting part is that even as a borrower, you can always just go and click on a link and see if the lender you're trying to get the loan from is
Yes.
licensed
That's
as
right.
well. You see, even their name is on FCCPC right there. Then you now know, okay, I know that this person is licensed. This person has registered under FCCPC. They have their certificate. Let me go ahead and take a loan from them.
It's
And then
like the way you put it. It's like what we see with the challenges of old e-commerce. If I'm going to, why is it that people don't pay upfront? Because they don't trust. And that's a major thing that is capping how our e-commerce will grow in terms of payments and so on. Trustworthiness, the trust between the borrower and the stamp, an endorsement that the regulator gives is going to be very key to move a lot of potential latent demand that are out there, people who are afraid to borrow, but actually need to borrow to get them into the market, which is going to be good for everyone. So I've just thought I should double click on that.
So now that this market is a bit uncertain, how do you see it affecting? It has reduced the market, of course. How do you see it affecting the portfolio prices and maybe the risk involved? Yeah, you might have like less risk, but how do you see it benefiting they themselves as lenders and also the users?
Perhaps that's actually the biggest benefit of this, one of the biggest benefit of this regulation. The part that compels everyone to put their data in the credit bureau is going to be one of our biggest revolution. There is, from international markets, there is a large correlation between the penetration of credit bureau into the population in terms of credit records, digital identity, and the scalability of the lending market. If I know who is a good borrower, it means that the risk of that borrower can be priced more appropriately in a fair interest rate that creates the right incentive for that borrower to continue to be good. For a bad guy to be identified and the risk of that bad borrower priced appropriately. One of the major benefits that this would do is that appropriate, much more targeted risk pricing. And it will fundamentally de-risk the market because the incentives to be good on the part of borrowers will be much more stronger than we have had before. A lot of good borrowers today are being penalized because they are put in the same bucket with the bad borrowers, and they are paying exorbitant interest rate. I mean, lenders do not want to hear this, but the way to look at the market is it better? It will be better in the long run to have a fair price at 30-40% margin that will reach 5 million people than to make 120% margin and keep a lot of borrowers from regular borrowing. And you limit the market to just 250,000 people or 300,000 people. One interesting data I should drop in terms of putting that conversation in context is the size of our market. I mean, it's one of the things we don't talk about. The shock is, according to Effiom, I sit on the board of Effiom. According to Effiom Access to Finance Research, access to digital payments in Nigeria grew in 2010 to 2023 from 22% to 52%, 13 years. So we made a lot of progress. But access to credit in the same 13 years, you'll be shocked by the rate, by the growth. It grew marginally from 2% to 6%, 4% growth in 13 years. I mean, it's embarrassing. If that tells us anything, it means our current structure, our current system, lack of order, lack of information asymmetry in the market is not working. And we need to do something radical, which is one of the things that this regulation is doing, along with some of the progress that we have done, we are making in terms of digital identity and some of the regulation with central bank in terms of the collection of GSI system.
Yes, thank you so much. I wish we had more people that could speak towards this and then just explain and explore, maybe educate people the more about what the benefit is. And if we're talking about the consumer side and weighing heavily on the credit bureau, I have seen that play out in real time. Luckily enough for us, we get to see certain things happen, and then we're like, oh, this is what has been mentioned. In the past couple of months, we've had, from the data, we've had a higher number of people fill credit bureau. And we've been wondering, why am I seeing more people filling credit bureau? The difference is that between July and now, more people are being mandated to submit data on
Hmm.
credit bureau. So you would see someone that is a recurring customer that has come and taken a loan from you and maybe repay. But previously, when you check that data as at, let me say, 2 months ago, they didn't have a credit bureau, but now the lenders are being mandated. I'm seeing a lot of people that are being reported in credit bureau, and you're seeing their loans going back to how many years ago, how many days ago. And of course, we have to tell the lenders are now reaching out to them that you have to go back and let these people give you like a letter of indebtedness to show that you're no longer owing, and then they are going back to go and correct all of their credit scores as well. We don't have a system that weighs heavily on credit scoring, but if this advances, we can start using credit scoring to use and tie it to certain things that other people want to do, which automatically forces everyone to repay your loan, and then the quality of borrowers would improve. I mean, if you're trying to get an apartment and then now they check BVN, now
Yeah.
they now check your BVN. If you're trying to get an apartment and you're hearing, oh, I'm going to check your credit score to see if you're owing someone money, automatically you would never want to
That's
owe
right.
anybody because you know that it's going to hunt me down. Invariably just forces people to come back. And it's not like they cannot go back to go and discuss, maybe try to rearrange their loan tenor or their loan terms with some of these lenders. They just know that nobody can hold them accountable,
That's right.
and they don't have any incentive for being a good borrower. So they just continue with it. It's crazy, but let's see what the industry just does and how well it's going to ever. So for now, how do lenders adjust underwriting when borrowers and lenders are like, if we are operating in an environment that is unpredictable, like that you can't predict what is supposed to happen, how do you even go about underwriting? I would like to think that is a miracle. We've been doing it in the past, but right now with this, we can now put certain things that says, oh, we must check XYZ and the rest of them. The people that I notice do that the most are the banks, because they have CBN that's going to audit them on a yearly basis and they have to be compliant. So yeah, let's see. So
Hmm.
yes, sir, please.
Yeah, interesting. I mean, the potentials to do smarter risk pricing and underwriting has never been. It's now going to be big. I mean, imagine a lot of banks use their retail base, consumer base, to amass deposits. They rarely, I look at the pattern of those big banks, they rarely lend to them. They pack deposits and lend it to corporates. For many of the banks, a much more pervasive credit bureau, credit history of customers, and even for the lender, I will get back to that shortly, means that the foundation data, both for banks and lenders and fintech, on which we can build next layer credit decisioning, is in place. It's like when the foundation is not there, there's a whole lot of guesswork and there's a lot of miss and hits and misses in the way we have done lending historically. So underwriting will be smarter. And I'm also had that the opportunity to now leverage smart technology on top of basic foundation credit history will make lending much better. And lenders should not be afraid. Banks, having worked in banks will still not do a lot of lending, despite the fact that they have a captive base, because the banks make too much money with treasury income and corporate banking. They will not innovate as rapidly as the lenders who are focused on this business outside banking. And that means an opportunity. Before the banks, in their typical slow elephant style and distractions with too many businesses, get it right, The opportunities for lenders who are smart and agile, leveraging technology, leveraging the power of foundation data or credit bureau system, and an organized market in which there are consequences for defaults and positive incentives to be a good borrower. The potential for smarter underwriting at scale has never been better, depending on those who embrace change first and move first. Because if you don't, the banks will eventually get there, and the market may be different. But this is time to move very fast and take advantage of the opportunities being created.
Okay, thank you. Talking about the banks moving there and taking over, I know they have like a higher leverage right now and being able to do that. But my question here is that how do they do that? How do they become more attractive at this moment? Do you have any ideas or anything you can trade for them? How do they make themselves very attractive? Because the market is about to get very competitive, right? Yeah.
For the banks who are very open-minded, who have major cultural shift in their mind, both at their management and board level, that consumer credit is not a high risk that cannot be managed. Because when you have a locked mindset, I don't want to touch it. And the incentive is that for them is we make too much money somewhere else. There's a fundamental potential risk to their base when smart lenders begin to lend to that base. But even if they don't, maybe smart lenders can also see it as a pattern opportunity. If I have the foundation smart algorithms to lend foundation credit bureau data, you know that the banks will still not do what they need to do enough. Smart lenders can also partner with them to access some of their base to customers that they will never lend to, and the opportunities for everyone will be very big. So smart, let me just summarize. Some banks will move, but banks being what they are will not move fast enough. And that represents the opportunity for focused, smart lenders to scale lending based on the new regulation and the opportunities of a much more perfect market where information asymmetry in terms of who's a good borrower and who's a bad borrower and who's a good lender, who's a bad lender is much more widely available.
So basically it's almost like the psychology is going to be driving the credit quality pretty much. It's a psychological thing. If I know that I'm going to be improving my credits, and then it automatically just shifts like the industry. But this time around, it's shifting the industry to have a more trustworthy environment and everything is legitimate and the rest of it. So if the repayment habits improve for these borrowers, for the lenders as well, do you really think lenders will be giving out more loans? I mean, they still have other issues when it comes to maybe funds and the rest of them, but repayment habits improving, what are the chances that everyone will still want to give out loans like they have been?
When repayment habits improve, also, I mean, like we said, this regulation is not standing in isolation. Nigeria is actually very interesting. One of the things the FCCPC does is, in other markets, the central bank or reserve bank, whatever they call it, has complete oversight over all the financial regulations and financial system. Because we have a situation in Nigeria where today, because of our federal system, some of our operators operate within the state license, not under the purview of central bank. So this actually brings the gap and close that gap, and everyone can tap into the global standing instruction system of the central bank. And just as we are discussing credit bureau system to cooperate to bring our resources together to make it work, that we also work with the central bank to leverage the GSI system. The digital system, this credit bureau system, this regulation all of them are going to work together to strengthen, to improve payment collection. And when that happens, it means more business for lenders. I mean, we are not saying go and be bullish from day one. As we collect more data in terms of transaction behavior, in terms of lending behavior, then we know what's the good pricing, how much rapidly I can increase my loan amount, what is the kind of frequency that I see, at what point am I potentially choking the borrower, and all these data are going to be very interesting. The potential to scale is going to be huge, as we have seen in overseas market that have gone through this kind of regulations.
Yeah, GSI is a topic that has come up a lot, especially for lenders. And I know it's always very heartbreaking for them when you hear the people that as of today can operate it, the restrictions in terms of it, and having to ensure that that loan is already booked on a CRM before you're even able to do the collection. But it's something that every lender is heavily weighing on or waiting to be available to them, because we're still seeing the repayment industry so far a lot of harsh way. Now everyone knows that. So at first it was just cards that were available for repayment, before now that we have direct debit that allows you to go into the account and do it. But direct debit is not available in all banks. But we've seen a lot of consumers move from using commercial banks into using the fintech banks, which is the likes of OP, PAMPay, and the rest of them. They are now using more of the fintech banks as well. But these fintech banks, you're not able to use them to do like direct debits, which now limits. But the usual people that are coming for, the consumers that are coming for 10,000 naira, they're coming for 20,000 naira, and the rest of them, they use this because this is the available option for them. I mean, it's easy access. When you use them to make payments, money just comes in instantly, and it guarantees them, especially the Uber drivers that are using the product. They're like, no, don't send to my account. I want you to use my OP because I'm getting my alert right now. But this account that they're using to operate on a daily basis cannot even be used for mandates, which means that they have a way of either escaping for repayment. There is no place that a lender can hold them, because the main account that they can only do mandates for, of course, OPP can use like cards and the likes of it, but mandate is only for the commercial banks, and is this other account. So it almost restricts them, because some lenders now say, oh, if I can't do a mandate for you on an account you're using on a daily basis, then I can't give you a loan because I need to be able to use it. But then, so there's still a whole lot of, there's a market that hasn't even been tampered with, because if you're giving loan to that category side of people, you have to find another way to ensure repayment and the rest of them. But do you have any comments with regards to that?
Very, very good perspective. I think those are the next things to do. The non-bank financial institutions numbers are growing. For fintechs to also benefit maximally from the opening of the banking system, it's also important that we are responsible, and the regulator sees us as such. So the direction of the GSI system will also be to bring everyone into the platform, as long as we are registered by an endorsed regulator like an FCCPC. It means you are not just someone in your jungle, or like a bandit, if I can use the word, who appears. It's very interesting we're saying that, because a bandit appears in Kano today and shows up in Lagos tomorrow. If you're lending business like that, the GSI system cannot, because it's chaotic. But if you are organized, right governance, the kind of structures that a regulator like FCCPC presents, you submit your regulatory report on time. The case for everyone outside the GSI system to be made to central bank to say, include all these guys because it means it's good for everyone, is very strong. So I see those things as next opportunities in terms of the payment collection system in Nigeria. But even without what it is today, there's still so much more to do with what we have today and tell a very good story for the next set of innovations that we need in regulations and in products.
Now, talking about these just brought me to the platforms and the partnerships or partnership models that are now available following the rules. Of course, FCCPC did not just stop at just the lenders, went as far as even the people you're partnering with, you have to be compliant and all of that. Do you see this lowering the risk of collaboration across all the platforms, or the lenders, the telcos, even as much as employees, because employees also take loans, right? I'm guilty of that as well. So do you see this helping the collaboration and also reducing the risk?
I mean, the regulator provides the regulation, FCCPC regulation, DEON, provides very clear guidelines for transparencies for partnership. And it says that it must even sometimes be reviewed for fairness by the regulator. And these are very important because lenders are very small businesses. When they want to partner with players who are large and with incumbent and strong dominant market power, they tend not to get fair deals in such partnership. One of the things I found very interesting about this regulation is talks about ensuring that there's no serious abuse of market power in partnership. These are some of the advantages that our fintechs should take advantage of. For example, in the telecom airtime business, one of the things said is that there must be a second player in terms of airtime lending who must be a Nigerian company. I think that's very progressive. It's an opportunity for our businesses. And we know that, wherever my old telecoms are, we know that in the telecom industry today, by subscriber number and share of revenue, the first two telecoms player controls 90% of telecom industry airtime revenue today. So it means that if we have a fair regulation around things like partnership with telcos that ensures fairness, that ensures there's no abuse of market power, is good for our local businesses. And it also says something like the terms must be fair. You cannot give partner A different term and maybe a partner B a complete different term. There must be a level of fairness between the two. So there are a lot of very good benefits when we look much more deeply into some of these regulations that we can leverage for business. So I see that, and of course, all the payment companies, the more lending grows, the more people repay, the more they use what they get for payments, and it creates a symbiosis between payments and credits. It is going to be great benefits to both industry, payments and the credit industry, in terms of partnership.
Thank you. I know this as well had made us, we had to actively try to do partnerships that also help to reduce costs for the lenders. Because the other concern is that, yes, we have all of this, but how do we ensure that the cost is being reduced in terms of, when you want to check credit bureau, you know how much it's going to cost. If you want to get like an extensive data, the cost of it, and then being able to incorporate that into a simple loan. If you're trying to give out a loan of 10,000 naira and you're already spending 1.5, if you're going to do credit bureau, if you want to do statement, let's say like about 2.5 to underwrite that loan, it already puts you at a risk, because definitely you have to put your interest to be minimum 15% and above for you to be able to break even on that. Or you might have to collect that money upfront from the borrowers and say, oh, this is part of your processing loan. So yeah, this partnership just allows everyone to be able to the main benefit of partnership is even to reduce costs. You can use the technology stack, you can use this at XYZ amount, a discounted rate, which now makes them to use it more and invariably just improve the quality of people that are giving loans. So you're right, it's a chain reaction. It's going around solving one problem is almost like solving other problems that the industry didn't really weigh heavy on in the past. So were there any risky part of that model of that's the model that has to do with partnership, or anyone that were ambiguous previously that they have corrected in the new DEON? Anyone?
I think if there's any, the level of detail in terms of transparency that DEON, it says put in your partnership agreement, put the terms, be very explicit. If there's anything, I think it can only just get better. And I must add something, that the credit bureaus, like you mentioned, are also dropping their prices for the microcredit segments. I mean, they are not charging the same thing, and they are business people. This is a business of scale. Maybe there is a very interesting, you mentioned this. Bankers have their associations. They have the committee of bank CEOs. That's one of the structures. That's why the advantage of market structure. They can engage regulators. They can engage industry, other industry. Maybe the lenders, the fintech lenders, also need to have their group. Approach the credit bureaus directly as a group and say, if you want to get better prices, I know they are reducing it, but leverage also your organized structure to also negotiate for better terms with the credit bureau, especially for certain levels of microcredit. But whichever way, on the long run, it will be far better to have got that credit information than to have given out 25, 50 million naira to people who will never repay back.
Yes. We have all of that now. We have more lenders that are onboarding in credit bureau, which just speaks to the partnership also benefiting them, because now we're saying you're going to come do this at XYZ and you're getting discount, and they're like, yes, I'll rather have these than have a high portfolio. Nobody is giving out money for free. It's the reason why everyone went into business is to be profitable. So I don't think anyone would see an opportunity that would make them scale or also have an assurance of repayment or filter the portfolio of people that are going in and just underwrite the loan properly and say no to that. So it's almost looking like with every single improvement DEON is bringing and the FCCPC is bringing, it can or it could boost capital inflows and also reduce the risk for lenders that are compliant. Do you think so?
Yeah, of course, I agree. I mean, I agree. Capital will be better and so on. Yeah, I agree with you. Yes. Yeah.
Okay. So which one of them, what tweak, you have spoken to the part that has made much impact, but is there any other aspect that you think that's going to make the highest impact on the market depth in terms of the regulation?
You mean in terms of the credit market?
Yes, please. Yes, please. The credit market.
The breadth of, there are many dimensions of things that are possible. First, I think the potentials for wider breadth of products in terms of innovation, when information about borrowers and their transaction behavior can be aggregated much more smartly for decisions. We will have much more, we will have wider and deep market in terms of different type of products by different markets. But I think one thing I should not forget to mention in terms of big depth and impact is MSME credit, MSME productive credit. There's a data from the National Bureau of Statistics. 4 out of every 5 Nigerians who are employed are self-employed. So really, the people, the salaried segment that lenders have been lending to, and usually federal, which is also narrower, is very small in terms of the potentials of people who do productive things. So the potential for us to do productive lending, not just lending for consumption or desperation, but I want to to buy a small equipment for my business, small inventory and working capital loan for a whole lot of MSMEs that are latent today, that this can unlock when information about them is available and no one can run away. And everyone has incentive to be good because they have good pricing, because we know that is huge. And that's what I see. And the social impact of what that will do in terms of lifting millions of our people from poverty to prosperity is a big thing.
That's true. That's true. I have one final question before I start taking questions from the audience. So, if DEON works as intended, what would Nigeria consumer credit landscape just look like in 5 years? I'm trying to envision what it's going to look like in 5 years.
We should see credit penetration from the embarrassing national credit penetration, like from the embarrassing single digit that we have today. We should see it at least at 3x. If we move it in 5 years to like 30% of population, and most of it are productive credit or credit that stimulates production. Consumer credits are good for consumption. If, for example, it is going to lead to consumption, or is going to create jobs in some other industries where the products being consumed by that credit is being produced, then the impact, because credit has a multiplier effect, so we can potentially see a 3x to 5x growth if we get this right. Along with some of the other things, we need to continue to tighten digital identity, quality, the collection system, get many more players into the GSI system, get FCCPC and central bank to work together as they are currently doing, and making sure that no one behaves like a bandit, either as a borrower or as a lender in the financial system. I don't think we can only be better for it as a country and as a nation.
Thank you very much for that. Even without us reaching 1 year from, that's me judging from what has happened between July and now, we are already seeing collaborations. Before, the conversations with Credit Bureau were usually, why am I spending so much money to get data from Credit Bureau? Meanwhile, when I want to submit, I'm submitting data to them for free. But when I'm trying to get information, I'm paying thousands of naira to get information from them, which usually makes a lot of lenders reluctant to running checks through Credit Bureau, because they didn't feel, and of course it's now mandating them to ensure that it's updating. They have to, data is now being submitted to them, which means they have updated information for users. You're not looking at reports and you're seeing still information about users on a monthly basis, and they're weighing heavily on it. They follow through on it 100%. You see them chasing, the data submission to certain lenders and be like, you've not submitted your data, what's the update? We've not received your inflow. So they're now heavy a lot on data submission. I have a couple of questions for you in the chat box, so I'll just take some. So the first one says, overabundance of credit can lead to inflation. Is that not a risk? Won't we be worse off?
There's no proven economics about that particularly, given our reality. If that is true, in Europe and more developed markets where credit is much more pervasive, they won't be having single-digit inflation. The things that drive inflation are not credit per se, especially when they are productive credits. What credit will do is it will make many more people far much more productive. It will increase employment and make many MSMEs prosperous in their communities, and it creates demand. These MSMEs are also the consumers of what Nestle's and the Unilevers will produce, and the multiplier effect of credit economy is a huge one. Never mind what government is trying to do something on the side, all these credit corporations, but the real thing is to unlock private sector credit through this kind of regulation, and the impact is going to be big. we should not, it's not about inflation. The potential about lifting people out of poverty is actually what we should be looking at into prosperity.
Yes, just speaking to what you mentioned, in the West, when we look at the access to credit has been a major concern for us here in this part of the world. I mean, you want to get a phone out there, you have to have the complete money for it. And now iPhones are going for millions of naira. So you're looking at people that are earning, like, let's say 400,000, average 400,000, to be able to afford the latest device that will boost their work would have to save for like what, how many months? If I am using 300K for expenses, this is minus rent that you have to save for the next year. You probably will have to save 100,000 to be able to get the latest devices. And mind you, technology has evolved so much that more features or more access to tools that can help you get your job done faster are out there, right? So I agree with you on that. Access to creativity will actually just improve the society in a whole. You don't have to, you want to pay your rent, you have somewhere that you can get money to pay your rent. Before now, they have accommodated people to do 2 years rent, although they have brought out a new rule that you cannot ask someone for 2 years rent. You must, I saw something like that this week. You must have minimum amount in terms of that you must give, even the timing for eviction as well. They put restrictions to that. So I'm going to take the next question, which says FCCPC tidying up the industry is a welcome move because it moves the non-bank lender sectors from being seen as a high risk towards institutional investors scrabbles to get in. Does this not now crowd out the smaller players? So the person is asking if this crowds out the smaller players or not.
There will be space for everyone. The market will get segmented as it grows. It will get segmented by product, get segmented by customer type, and get segmented by risk profile. In those 3-dimension variables are different opportunities for everyone to play, either in a large segment or in certain product risk niches. So there'll be spaces for everyone. And in a period of growth, there's really no consolidation. It will be innovation into different spaces. The years of consolidation are still very much ahead.
Thank you. I'll just try as much as possible to cover as many questions as time permits. I have one that says, why is the CBN not helping the money lenders with access to GSI?
Yeah, because that's why we need to organize ourselves professionally. As we are credible people that do good business, who do not run away, who we have the office and we do business professionally and ethically. Maybe one of the conversations that we should have, one of the things that you come out of this conversation is the lenders organize yourself into a group. CBN actually would prefer to have a president or a chairman or something to talk to, and they begin to see you differently. If today agents on the streets of agents of the fintechs on the street who are doing cash in, cash out, they have a national association. Please also have your own association. Organize yourself, which means you can also discipline your member. You don't spoil our good name. We can meet director of banking supervision or director of non-financial institution in central bank because this is who we are. So I think if we do that, and one of the things that this FCPC does is that it enables us to have that stamp. We're organized. We submit regulatory reports. Use that report. Oh, therefore, the regulator is comfortable to deal with it. But when we have what I call an atomized, scattered system where people are in different places, who do they deal with? So the cases we want to make about being involved in GSI can be made through an organized structure of the lenders association, and which I think this kind of forum provides. And maybe Lens Square can also make it happen, help to organize the industry and put them together into a formal group. Everybody does not need to join. We just need 30% critical mass to be part of it And everybody begin to see the benefits of being part of the formal system. And you can also use that to negotiate with the credit bureau as a group in terms of pricing.
For us here, we are heavy on different sectors and different partnership in terms of, let us put together the available people. We even have money lender associations as well, where we encourage lenders to join the money lender association. We as a provider, we are in there when we have our lenders, but like, you need to be part of this association where they discuss, they meet on a monthly basis, and then everything that has to do with the industry, they're posting it there, they're keeping you leverage on even partnerships. In terms of any partnership the association gets, you also benefit for that. I'm just going to quickly take on more questions. I see we have just 5 minutes. I have one that says, could DEON-CL trigger market concentration, and what would that mean for innovation and competition?
During, like I mentioned earlier, during this period, concentration is less likely, because you will see the industry will grow in different segments, products, and dimensions. But even if there will be consolidation, maybe it's a challenge to say, if any player slips on their oars now, and we get to a period of consolidation in the years ahead, in which your scale is small, because that business did not embrace change enough to ride the wave. When the wave begins to temper, then those small, tiny players may be consolidated. But it may be a function of what they do now. Embrace change, take advantage of regulations, because you can't do anything about it, even if you don't like it. The right business strategy is to say, how do I take advantage of the regulatory shift and do the best with it? And of course, and there's a whole lot of positives, like we said, that are in there.
Well, thank you so much, sir. I have one from David Falana, and it says, the cost of lending is already high. Paying additional fee to credit bureau will also increase it more on the service charge to be paid. What would you do to assist? I have a feeling this might be tailored towards me. So for us, we have partnership with the credit bureau to reduce all of this cost. On a typical day, if you were to go and connect with the credit bureau, you have much more to pay depending on which credit bureau. You have to do integrations with about 3 of them, while on Lens Square, you are able to just use this technology we have. You don't have to do multiple integrations as well. But we've reduced the partner with them to reduce the cost significantly. We're paying thousands of naira to get a single credit report, but all of this is now available on Lens Square lesser, and it meant us going to have partnership with the credit bureaus for each of them to be able to offer you a lesser price. So yes, that's how we are making impact, or also helping to reduce the cost. So I have just 2 minutes, and I'm not sure we'll be able to take all the questions that we have here, so I can take the closing remark. I want to thank you so much, sir. It's always nice to have someone come and share a different perspective here. We have over 100 of people that have joined today, and that has meant that this topic is one of importance to them, and I believe they've been able to learn, and we have less conversations with people. Why should I do FCCPC, and them shifting to not even doing it? So I want to say a big thank you so much. I really appreciate your presence, and I appreciate everyone that came.
Thank you. Let's make a difference, bring more people to the credit system. Nigeria needs it. We need more people to be lifted from poverty to prosperity. Let's make it happen. Thank you very much for the invitation.
Thank you, everyone, and do enjoy the rest of your day. Thank you.